Okay, welcome everyone. Nice to meet all of you, and welcome to 5 Paisa Live. Hit subscribe button to get insightful webinars such as this one, and yeah, look forward to having a discussion with all of you about a new fund. I think this is a fund that we're very excited to launch. It's something. It's a bit of a historic, a bit of an iconic fund, and maybe I'll use the next 15 to 20 minutes to talk about why international investing and why specifically this fund, and then we can open it up for questions. In the meantime, if people want to ask questions, please feel free to use the comment tab, and I'll definitely sort of towards the end of the presentation, get in touch. I'll be able to answer those questions. So, before I go to the fund, I think maybe I can spend some time to talk about why international investing. Why is something that people should take it seriously? Why should this be something important in people's portfolios? But also before that, I'd like to introduce myself. So my name is Pratik Oswal, and I'm from Motilal Oswal Asset Management Company. I'm currently the head of passive funds out there. So I look at seven index funds and three ETFs. So today, if you see a portfolio of passive products, Motilal Oswal is the only AMC that have passive funds across large cap, mid cap, small cap, multi cap, sector, as well as international. So very comprehensive, and we look forward to having your support in all those funds. But I think that's my background in terms of why international investing. I think so. Before this, I was managing money for people in the US, and every investor in the US or other parts of the world, they have every investor I saw had a minimum of 20 to 40% allocation to international equities. And today, as I see, almost no one in India has an allocation to international funds. So I'm here to build a case and to tell you some of the positive attributes about having an allocation to internationals, and what sort of benefits you can have from at a portfolio level. So why international investing? So I think one important aspect is that international equities and Indian equities move in very different directions. So Indian mutual funds have a correlation of close to 80-90%. So just to give you an example, the last 2 months, regardless of you held a mid cap fund or a large cap fund or a multi cap fund, everything was down 10 to 15%, 10 to 20 to 30%. And I think when it comes to international investing, what we've learned is that it moves very differently. So the correlation is close to 15%. That's all. So I think it's a great way of diversifying a portfolio. Today when we look at diversification of portfolio, we think about debt, we think about gold, we think about real estate. The problem is all those things reduce your returns of your overall portfolio. So here is one asset class that can maintain the same returns as equity, but also reduce the portfolio volatility in a very big way. So I think that's why we think international investing is great for portfolios. In terms of, I think apart from this, one important aspect about international investing, especially in this fund, is the fact that this fund offers you two asset classes. One asset class is some of the world's best companies. The other asset class is dollar, and dollar as a currency is extremely important. Today a lot of our expenditure is happening in dollar, but our income is happening in rupee. To share a personal example, I studied in the US. If I go to the US today, for the same college, same degree, I, I would pay close to 2.5, 3 times for the same education. And the reason to that is because dollar used to be at 40, 45 when I went. Today it's at 75, 80. So close to 90% depreciation in dollars. So I think if you look at today, all of us, we are doing a lot more foreign trips. We are buying a lot of foreign goods and services. If you're buying an iPhone today, the reason why it's 1.5 lakh is because more to do with depreciation and less to do with the cost of the product. So I think holding the dollar extremely valuable, and we expect the dollar or the rupee to depreciate or weaken even as we have in the last 2 decades to continue going forward as well. So this fund offers you protection towards losing money via depreciation of the rupee. To give you another example of rupee depreciation, so if someone in the US had invested in India 10 years ago, their returns would have been 0.8% CAGR. That's about it. Whereas an Indian investor would have made close to 10 to 12%. So what's important to understand is that I think the dollar has eroded a lot of the value creation that has happened in India over the last decade, which is why dollar is very important to hold, and that's why we say have a minimum of 10 to 15% allocation into dollar-based products. Third reason why international investing is important is because of the rupee, is because of competitive landscape. So if you see in India today, the competitive landscape is very, very different. You have a lot more foreign brands in India. If I had to buy a car today, my option would not be just Maruti or Tata Motors. My option would go to a Kia or a Hyundai. So I think international. So I think your portfolio should represent your consumption. Which is why I think having brands such as Netflix, Amazon, Google, WhatsApp, Facebook, Coca-Cola is very important, because then your portfolio is having the same number of companies or a better diversification, because you are consuming these products on a daily basis. So I think internal investing, as I said, is extremely important, and everyone should, because of these three reasons, should focus on international investing. So then coming to this fund, so what is the S&P 500, and why is the S&P 500 important? Why should anyone take this fund seriously, and how is it compared to other international funds out there? So the S&P 500 is a very historic index. It was actually the first, or I would say the world's first index fund, world's first passive fund, launched in the 1970s. It was launched by this company called Vanguard Mutual Fund, which was back then a startup. Today, almost half a century later, Vanguard is today the world's biggest mutual fund, and S&P 500 is the world's biggest mutual fund in the world, biggest index fund in the world. So you're looking at a fund that tracks close to $10 trillion worth in assets. That is 3 times India's GDP. That's how big this fund is. When people talk about how the US economy is doing, they refer to just the S&P 500. It captures 82% of the entire US economy in one fund. You're getting top 500 companies, all large cap securities. And even though this fund is a very US centric fund, it's listed in the US. It's important to understand that 40% of the sales of the S&P 500 companies are coming from their operations outside of India. So if you look at a lot of these stocks of the S&P 500, look at Amazon, Netflix, Google, Spotify, their US businesses are very steady, 5, 10, 15%. But if you look at the international businesses, that's where they're growing exponentially. So what you're getting in this fund is getting some of the largest companies, but you're also getting their international or global expansion. So I think that's very important, and that's why the S&P is, I think, an extremely important fund. In terms of, I think, what is the S&P 500? The S&P 500 is the top 500 companies listed in the US. So it's a top 500 companies listed in the US. It's all a pure large cap index, and it's also, I would say, a default gauge of the US economy. As I said, it's also actually recommended by some of the world's best investors. So you look at Warren Buffett, look at John Bogle, Burton Malkiel. In fact, what Warren Buffett said is that when he passes away, he wants 90% of his savings to be held in S&P 500 index and 10% in government bonds. I think it's a fund that he would put all his money in, and we think it's extremely important. Today, if you see, I spoke about some of the reasons to why you should invest internationally. Today, all our investments are only focused in Indian investments, which is only 3% of global GDP. So we are missing out on 97% of global growth opportunities. This fund gives you access to 20 to 21% of global GDP. So I think if you add this to your portfolio today, you're getting the world's fastest growing country, which is India, which you already have, and you're also getting the world's largest country, which is the US. So I think that is the opportunity out here. I went through some of the benefits earlier on. So why this fund is important? The correlation of this fund is it's close to I would say 0.135%, so extremely low. So as I said, this fund offers you diversification without sacrificing returns, which I think is extremely important. It offers you dollar as a hedge. So for example, the S&P 500 in USD grew around 5 times in the last, I would say, 20 years, but then the INR grew almost 9 times. So I think whatever depreciation happens in the rupee will be added to the returns to this index, to your investing in this fund. In terms of, I think quality of companies, I spoke about this very early on. You're looking at some of the largest, most popular, and the highest brand recall companies in the world. So if I showed you a list of the S&P 500 brands logos, and if I give you a list of the Nifty 500 companies, I'm sure most of you should probably identify more with the S&P 500 companies. So I think that is what you're getting. Most of these companies we all know and we use on a daily basis, and this is the opportunity. In terms of historical sector, this is a very good feature that no single sector has a huge bearing on the returns. So if a certain sector does not do well, it does not impact the returns in a meaningful way. So you're getting something which is very simple, very low cost and very diversified. So I think it's a very, I would say, low risk strategy for you to buy equities outside of India, and it's in a form of an index fund. What that means is that your portfolio will never do badly. You will just follow the index, and because of this following the index, I think you can expect this to be in a portfolio a very long time, because we all know that poor performance is why we churn portfolios. We eliminate poor performance, then we can expect this to be held in a portfolio for a very long time. Plus, in a country like US, what we've learned is that the index has done better than 90% of all other active funds, all of the funds. So I think when it comes to geographical expansion or geographical diversification, index we think is the best way to go, because you're saving returns, you're not getting poor performance, and you're also getting a fund which will do better than most of the funds out there. So in terms of, I think, in terms of value creation, there's three ways in which you will be able to benefit from this fund in terms of returns. One is your underlying index. So the index is appreciated between 5 and 9% every year for the last decade. Second is dollar depreciation, dollar appreciation or rupee depreciation. The rupee is depreciated by 3 to 5% every year. So that is the amount that will be added back into your NAV. So you will make returns of that. And thirdly is dividend yield. Dividend is extremely important. In India, dividends are very low, but if you look at dividends in the US, dividends are, so if you look at the dividend yield today, it's almost 2.5%, which I think is extremely high. You're getting 2.5% that's invested back into this fund, every almost every year. So I think there's a lot of creation of value from this fund. If you look at dividends, so the S&P 500 in the USD, so not in INR, in a dollar, appreciated 10 times in 30 years. So 10x in 30 years. But if you include dividends, it's 20x in 30 years. So that is the magic of dividend compounding. And this is why I think it's very important for us to, I would say, invest for dividends for long time periods. Then we talk about returns, So I do think returns is not the most important criteria. I strongly believe that returns is, I would say, it's important, but should be the least important, because as we all know, returns are very volatile. Returns are uncertain. Returns are hard to predict. But if you look at the returns of the S&P, it's given you 18%, almost 18% over the last 10 years, whereas any other Nifty 50 or the Nifty 500 is giving close to 5.5%, 10%. So I think if you look at 3 years, 5 years, 7 years, 10 years, the S&P is done between 4 and 8% more than the Nifty. So I think returns has been great. Half of the returns have come from the index, and half the returns have come from the rupee depreciation. So I think investors can expect, I would say, not the same, but I would say same returns as what they would expect in India, but they would get a lot of diversification. So this is a very important question. Most people ask me, how is the S&P different from the Nasdaq? So Motilal Oswal also has a Nasdaq fund, which is extremely popular. Very popular index. We've been running it for almost 8-9 years. Now it's become a very big fund. But what we've seen with the Nasdaq is that Nasdaq is a little bit more technology heavy, so sector concentration is slightly higher. Yes, the returns have been very high, so looking at 20-22% CAGR last 10 years. But sector risk is a little bit high because Nasdaq is almost half the Nasdaq is technology stocks. Number two, the Nasdaq is also a little bit less number of stocks. So S&P is 500 stocks, Nasdaq is 100, and S&P is more comprehensive. So I think the S&P will give you 80 to 82% of the entire US market, where Nasdaq is close to 30%. So I think the subtle differences, but I would say the S&P is a lot safer, less volatile, whereas the Nasdaq obviously has a lot more technology. So I think if you're expecting technology sector to go up, or if you're looking at more of that, then the Nasdaq is a much better bet. So lastly, coming to our fund, so we talked about why international diversification is important. We talked about why the S&P 500 is very important. Now we talked about the S&P 500 index fund. So Motilal Oswal is launching an index fund. It's not an ETF, it's not a feeder fund. We will be buying stocks. So we will be buying 500 and selling 500 stocks on a daily basis. These are so you're basically, if you see your portfolio statement at the end of the year, you will have the names of 500 of these US companies in your statement. So this is an open-ended index fund. So the NFO period ends tomorrow evening, 23rd, at around 10 or 11 o'clock. So the opportunity here is to make sure that you have some participation in the NFO, and the NFO opens on the 29th of April. That is when it becomes open-ended, so you can do inflows and outflows about around then. So I think so in terms of fund, it's an index fund, so very simple format. It's like a regular mutual fund. You go to the AMC, you pay the NAV price, and the AMC will give you units in exchange. There is the total expense ratio of this fund is around 1%. Direct plan is 0.5%. There is an exit load of 1% for up to 3 months. So 3 months, if you sell it before 3 months, then you will be charged 1%. We don't recommend you to buy this fund for trading purposes. You have to do it for investing purposes only. We do believe that you should have a minimum 3-year horizon, 3 to 5 years. 5 years should be minimum. And the tax structure of this fund is going to be debt taxation. As per regulations, all international funds have to be taxed as debt. So this fund will also be taxed as debt. But having said that, if you hold it for 3 years, then you can expect taxation to come down to close to equity taxation. So I think you should be looking at this from a very long-term perspective. You should be looking at this from a 10 to 15% allocation of your overall equity portfolio. And you should be looking at this from getting access to some of the world's best companies. And today, every mutual fund has an HDFC Bank in that. But here you have an opportunity to buy some of the best companies that are as good, if not better, than HDFC Bank. So I think that is the premise of the fund. So just to summarize, I think just to quickly summarize this fund, the world's largest index fund now available in India for the first time. You have, I would say, diversification opportunities in your portfolio. You're buying the dollar, which is very important. You're buying some of the best companies, the brands which are phenomenal. And honestly, you're buying it at a low cost. Low cost is very important. You're saving fees. You're buying the index, which will do better than most of the active funds, and you're also getting something which has delivered great performance in the past. So with that, I can go ahead and answer some questions. Thank you so much. Yeah, so there's a question on expense ratio. So in terms of expense ratio, the total expense ratio is 1%. Direct plan is 0.5%. In terms of dollar difference, so this entire fund will be held outside of India in a dollar-based account. So it will. So basically, because it's in a dollar, it's in a dollar-based account. It will reflect whatever rupee and dollar happens. So if the rupee depreciates by 5%, that value of the portfolio will go up by 5%. So I think this will be reflected in your NAV of this fund. So the NAV will reflect the dollar exchange rate every single day. That's how you can track it. So any depreciation of rupee will add returns into your fund. So so there are no hidden charges. The expense ratio is the only charges that you can expect. So mutual funds are very highly regulated by SEBI. So we are not allowed to have the expense ratio covers all the charges that you can expect to have in this fund. Yeah, so there are no hidden charges. So what is the advantage of investing in the NFO? So the advantage of investing in NFO is the fact that you're investing in early. So I think a lot of the money that we collect during the NFO, will be invested together. Will be invested together. So the pricing will be slightly better. And number two, I think you're getting the 10 rupee NAV price. But yes, I think you could also come in after the NFO when it opens on the 29th of April. So I think in terms of investing, if people are looking to invest in this fund, the 5paisa platform is great. So you can just use the platform to invest in this fund. So the NFO ends tomorrow, so I think it will be available there. There are no NFO expense charges. So as I said, expense ratio is the only charges that you can expect. You can buy it on 5paisa's online platform. You have an NFO section out there, and you can purchase it from there itself. In terms of procedure, you can go to the 5paisa platform where you have the NFO section, and you can buy units there. So you can apply for lump sum as well as SIP. In terms of frequency of rebalancing, we do it quarterly basis. So the index rebalances on a quarterly basis, and that's how we would rebalance it. But if you look at the last 3 years, the S&P rebalancing the churn has been, I would say, less than 5%. So what you're seeing is a lot of these 500 companies are extremely stable. They stay for a very long time. Will this fund beat the Sensex in the future? No one knows, but I do feel that the returns of this fund will be similar to the Sensex in the next 5 to 10 years time. The reason why you should buy this fund is because they will lower the volatility of the fund of your portfolio dramatically. That is extremely important. So it will be easier for you to handle swings in the market. Second is it'll give you dollar as an asset. So I think dollar is extremely precious. And thirdly, it's giving you a lot more stock level diversification because you're buying some of these best brands. Yeah, so you can do SIP as well as lump sum. So we would recommend you to do an SIP in this fund because I think what we're saying is that to have a minimum exposure of 10 to 15% in international funds, and I think the idea is to build it slowly over the next 6 to 12 months. So we would recommend doing an SIP as well as a lump sum for the NFO. So this will not be invested in India. This will be invested completely in the companies that you see in the slide. All international companies, all some of the world's best brands. So this is not an ETF. This will not be traded on the exchange. This will be a pure index fund. So this will be just like a regular mutual fund where you have to go and buy units from the AMC, and the AMC will give you units based on NAV price. So yeah, these are not exchange. They're very, very simple products. You don't need a demat account. You can set up SIPs very automatically. You don't have to worry about liquidity on exchange. All of that. So index funds, what we've seen are a lot simpler than ETFs from our experience. So Motilal Oswal has Nasdaq already. So Nasdaq is the only international fund, and now we are coming up with S&P. Nasdaq is as popular as S&P, but S&P is a little bit more diversified, less risky, less volatile, and a lot more broad-based. So it covers a lot more companies. Tesla is a part of S&P. That's right. So you could buy companies like Tesla through this index. So you can purchase once a day. I think so. In any mutual fund, you have to purchase once a day, and the units will be delivered to you next day. So this is exactly how that will be. It runs like a very simple mutual fund. Even though it's a international index, there is no further declaration. You don't have to do any tax, nothing. Every It's in terms of I think the way it's structured. It's a rupee fund, so there is no restriction for anyone for this fund. So in terms of past performance, I'll just go to the slide. This is a slide for past performance. And what we've seen is that this fund has outperformed the Nifty by between 4 and 8% every year over the last 10 years. So I think outperformance is strong. But I would say that don't invest looking at returns in the past. Past returns never end up, I would say, performing in the future. I would say, and I think it's important to understand that yes, you can expect good returns, and I think returns can come from from three sources. One is the index, second is dividends, and third is rupee depreciation. Yes, the NAV is declared at the end of the day. I think the NAV is declared at around 7:38 p.m. So that is the time that we declare NAV. Yeah, so I think in terms of lump sum and SIP, you can invest in lump sum today, but once the fund opens for subscription on the 29th, then you can go out there and apply for SIP. So SIP might not be available at this point of time with some of these apps, but you can do it after it opens on the 29th. The purchase will be made on the same day. So if you invest before 3 p.m., then that cash will be converted into USD and invested in the same day in the US market. So you can expect it to be deployed in the same day. So the Nasdaq and S&P is the Nasdaq has 100 stocks, but out of the 100 stocks, around 85 stocks are overlaps between Nasdaq and S&P. So in terms of stock level overlap, it's relatively high. In terms of proportion, it's 30%. So 30% of the Nasdaq would be, I think the S&P covers 30% of the Nasdaq. Yes, so you can buy it from any of the online platforms. You can also buy it from the 5paisa platform. So I think I'm pretty much done with most of the important questions. So with that, I'd like to thank all of you for joining this session. So I am available on social media, Twitter, Facebook, LinkedIn. Please feel free to get in touch with me if you have any questions. I again request you to subscribe to the 5paisa YouTube channel as well as the mobile app. Thank you, 5paisa, for having me out here, and look forward to having these discussions with you in the future. Thank you so much.